Welcome back, you legends. I'm Dr. Ken. Let's get right into this video. This was a crazy day in the stock market where the Nasdaq closed 1% in the green, the S&P 0.7%, and the Dow 0.3%. Let's take a look at the different sectors. Leading today were energy, communication services, real estate, tech, and basic materials. Lagging were defensives, financials, and consumer cyclical. So it's a bit of a mixed bag. But if we take a look at the monthly relative performance, what do you notice? Healthcare, utilities, defensives, basic materials, all of the defensive sectors led the entire rally this month. And look at this, the biggest loser, energy, financials, and cyclicals. What does this tell you? The best performing sector in the year was energy, and it's the worst performing sector this month. It tells you one thing: recession fears. Fears of recession, fears of global slowdown in growth, and that's why you see defensive sectors like healthcare, utilities, and consumer staples leading, with energy, financials, and cyclicals lagging. That's investors busting out their recession playbook. That's exactly what's happening. And so throughout this rally this month, in fact, the last 2 months, we had defensive sectors leading this rally, again reminding us that we are still squarely in a bear market. Let's take a look at the stock market map. Look at this, bright red is Tesla, healthcare, as well as financials. Today was led by some tech companies, including Microsoft, Nvidia, Google, Meta, Amazon, as well as energy and real estate companies. But then again, if we take a look at the monthly performance, what do you notice? Look at this, consumer defensive leading, healthcare plans, and utilities. So all of the defensive sectors leading, with energy, cyclicals, and technology lagging. Now let's take a look at the daily chart for the S&P 500, and what do you know? Exactly what we were expecting yesterday happened today, and that was this. The market rallied, opened with a massive $10 in the green on the S&P 500, and then we immediately dumped, forming this very clear double top formation with a massive negative divergence. Now, if you look at the CPI report that came out today, what you will notice is this. We had a major miss in both the core inflation rate as well as the headline inflation rate, coming in significantly below consensus and below forecast. And that's why we had that massive pre-market jump in the S&P 500. Now, interestingly, what we were used to was when the CPI missed, we'd see something like this, a massive gap up and then a continuation of the rally. The exact opposite happened today. We gapped and crapped. And if you take a look, everybody, at the October 13th bottom, you will see a mirror image of what happened today. We had a massive beat in CPI. CPI came significantly hotter than expected. October 13th, we had this massive gap down, and then the market ripped to the upside. We had the exact same opposite happen today, right? CPI missed, so that was a good thing, but the market gapped and then crapped. So we're seeing a mirror image, and I am 99% confident in calling the top boom right here. The charts don't lie. We're seeing an exact mirror image of what happened in October. If you notice, guys, look at this, a double bottom, significantly lower low on the price action, and then a significantly higher low on the PPO, and that marked the bottom, and we went long October 13th. What we did today was the exact opposite. We went full short. Well, because what do you see? You see a double top with a significant negative divergence. We're seeing the market dump even on good news, and that's the hallmark of market tops. So again, I'm confident in calling a market top today. In fact, I opened a whole lot of positions today. So many positions. By the way, guys, I do share all of my positions, all of my trades and my investments in real time in the trading community. It's $35 a month if you go for the annual membership. And what do you get in return? Well, you get real time technical analysis, intra-market, pre-market, and post-market. I post all of my work, all of my charts, really everything in the trading community. This is what it looks like. I'm at UTC plus 3, everybody, so 5:35 p.m. for me is actually 9:35 a.m. Eastern Time. And that's exactly what we saw. We finally have our double top with a negative divergence. This is probably the cheapest short we are going to get, even if the SPY rallies to 416, which is the resistance level of this ascending wedge. Even if that happens, this double top will still stand. We are selling off right off the gate, suggesting that this may be an exhaustion gap topping formation. Be careful out there. I will begin opening shorts. And that's exactly when I started to short a whole lot of different companies and indices. Trades that I expect to net anywhere between 500% to 1,000% by March. This is where I post my daily stock market analysis in the live analysis channel. I also post all of my trades and investments in my trades, as well as any update to my $1.1 million investment portfolio. I made a major change to my investment portfolio just a couple of days ago. Again, I shared all of that in the trading community. I'm also building a library of all of my charts in my charts right here, where you'll be able to get a live link to every single chart that you see in my videos, where you can click on it, get the exact same chart with all of my drawings, my channels, my wedges, my price targets, my resistance and support levels, as well as my weekly expected moves, which I post in my weekly watch list. All of that and a bunch of more cool stuff. Yesterday was pretty good for us. We had members posting 200% gains, some members posting 87% gains, 120%, 30%, 46%. I'm not going to go through all of them. This channel, the Gain Porn channel, is open for anybody to check out. The Living Legend membership, which gives you access to every single room in the trading community. And then we have the Ghost Legend membership, which also gives you access to every single room, but you will not be able to post except in the graveyard. That's because I have to maintain 1,000 member cap at any given time for the Living Legend membership. So I'm able to interact and respond to your questions. I do have a 30% off discount as of now. That's 30% off the annual Ghost Legend membership. Now, getting back to the daily chart for the S&P 500, everybody. This black bar represents the expected move for tomorrow, which is $7 to either direction. That takes us to 409 to the upside and 395 to the downside. Now, interestingly enough, if the market opens at this 200-day moving average, we'll see something that looks more like this. We could see a 2 sigma move that's a full standard deviation below the daily expected move that would take us all the way back to the opening price for last month's CPI report. And we could in fact continue to go down for the rest of the week to the lower weekly expected move, which is at $380. Now, with that being said, even if we see the market attempt a recovery today, something that looks like this, an attempted recovery, even if we see that will not invalidate this double top formation. And again, this top will hold. And in fact, I took a $100,000 position betting that this is in fact the top. Again, guys, you can follow all of my trades in the trading community. Check out the link in the description below. Now, if we take a look at the weekly chart, we'll see something very interesting. What do you notice, guys? Look at this. We had a rejection exactly at the 50-week moving average, similar to this rejection back here on August the 15th. And honestly, this top is eerily similar to this top. And unfortunately, if we see a continuation of the downside from here, it's going to be a painful end to December. We've been expecting a monster rally for a while, and we got it. We got it twice. We had this monstrous move to the upside. We had another monstrous move to the upside today, completing our double top formation. There are a plethora of ways to position yourself to take advantage of the next move to the downside, which I expect us to be at $320 by March of next year, perhaps even as low as $300. There are so many ways to position yourself for this next down move to generate anywhere between 500 to 1,000% return. Yes, 1,000%. Again, guys, all of the details are in the trading community. Now, let's jump to the daily chart for the triple Qs. And again, boom, a triple top formation. Very obvious triple top formation with consecutive lower highs on the PPO. Very significant negative divergence. and massive volume to the downside. This is an obvious distribution day. Again, big volume to the downside today, marking this as the first major distribution day since early November. If we take a look at the triple Qs divided by the S&P 500, we can clearly see again a rally to the 50-day moving average, a rejection and a massive sell-off. This is what I call a false break top, where we break the resistance line of this bear pennant, we fail, and this is usually extremely bearish and it leads to massive losses in the next few weeks. That's what I'm expecting. I'm expecting the sell-off to begin as soon as Wednesday of the FOMC announcement and projections, and the continuation of the sell-off well into March of next year. Let's take a look at the Dow Jones again. Again, we have a double top formation with a significant negative divergence. The PPO is still pointing down. We're squarely in bearish momentum mode, and the Dow has been topping for a while now, really ever since we had this crossover back here early December. The Dow has been topping and it has now formed a double top formation, and I expect significant weakness to come to the Dow. But again, I expect the triple Qs to significantly underperform the Dow and the S&P 500. So if you're looking to short the market, the triple Qs are probably your best bet. Let's take a look at the VIX. The VIX had this massive gap yesterday. Even though the market was rallying, we saw that the VIX shoot up to the upside, and we had a massive gap fill today. Now the VIX is primed for another move to the upside as soon again as Wednesday of the FOMC projections. Now the structure on the VIX does look like an inverse head and shoulders that is looking to perpetuate to the upside. A full measured move on this inverse head and shoulders, let's see, would take us to 35, which was the prior top. Again, that's well within what you would expect for the VIX. These gaps, guys, are common in the VIX. We had one back here at the exact same spot that we are in right now. We had the top, then we had this attempted rally. It failed, and it produced this massive gap. We filled the gap, and then we continued to sell to the downside. We had the exact same thing. Look at this, the top right here, attempted rally. It failed. We had a gap fill, and we are now ready to perpetuate to the upside. So I'm expecting some pretty big moves in the next several days, including again, a $10 plus move in either direction by the end of the week, probably to the downside. Let's take a look at another chart. This is the Dow Jones Industrials up top and the Dow Jones Transports down below. We had this very long established negative divergence where the Dow Transports formed a lower high while the industrials formed a higher high. In Dow theory, this divergence always leads to significant changes in direction to the downside. We had that change in direction early last week. We had this now attempted recovery. We always get this attempted recovery after a cross down. We had that and it always fails, and we are now seeing that failure, and we'll see some significant downside from here in my humble opinion. Let's take a look at another chart. This is the SMH, the Semiconductors Index. This has been the best performing index in the last, I think, 7 years, with the exception of 2022. Semis have been the best performing sector in the S&P the last 7 years. And it's a great barometer for the health of the economy as well as risk appetite. And again, look at this perfect triple top formation. Sell off, sell off, sell off, distribution, distribution, distribution. Bears are stepping in systematically at this level. We have significant negative divergence. And unfortunately, this bull flag on the daily chart will eventually break to the downside. We had similar bull flags in the past that always broke to the downside, including this bull flag that broke to the downside, this double top. We have now a triple top. We have all sorts of negative headwinds, including a PPO that's now pointing to the downside. We're going to see significant downward pressure in this SMH that will bring down the triple Qs and the S&P with it. Let's take a look at another chart. This is XLY divided by XLP. Yesterday, I drew out this descending triangle. Descending triangles, guys, are bearish technical structures because we see successive lower highs. These lower highs indicate that bears are getting more and more courage too short at lower and lower levels, bringing down the price to where the bulls are holding the line. Eventually this line breaks and we see a waterfall style sell-off. I'm expecting that to happen again as soon as Wednesday. Let's take a look at the DXY. Again, we had a descending wedge structure. Descending wedges are usually bottoming formations, and the dollar has had a significant negative correlation with the S&P. And so I'm now expecting the dollar index to shoot to the upside on hawkish Fed comments and projections that will drive the dollar to the upside and crush the stock market. Same thing with the 10-year yield. We now have a very obvious look at this inverse head and shoulders. We have the PPO crossing over. We do now have significant bullish momentum in the 10-year yield, bullish divergences. And now I expect the 10-year yield again to rally all the way up to 3.9%. Crushing valuations in the S&P 500. Let's take a look at another chart. This is stock market breadth, percent of S&P 500 stocks above their 50-day moving average. And what do you notice? I drew out these vertical black lines yesterday in yesterday's video. I said we are here today, which is the exact same spot that we were back in August, late August. What do you know? Boom, we rallied exactly like late August. Boom, a rally. And now I'm expecting this rally to fail in spectacular fashion, a fast and quick boom, crash to the downside. Let's take a look at another chart. This is the McClellan Volume Summation Index. We did have a cross down. Again, in yesterday's video, I did say every time we had a cross down, we had an attempted rally. It failed and it produced more downside. Attempted rally, failure, and a continuation to the downside. Again, we had a cross here, an attempted rally, it failed, more downside. We had the exact same thing happen yesterday. Attempted rally, failure, and we're now getting ready for significant downside ahead. Let's take a look at another chart. Again, I drew out these levels yesterday. It's funny. I drew all of these out yesterday and the market behaved exactly as we expected. We had these significant higher lows on the put to call ratio. Even as the market continued to make higher lows and higher highs, the put to call ratio actually continued to make higher lows. So we had a significant bearish divergence whereby more and more puts were being opened every single time the market tried to rally to the upside, indicating more and more bearish momentum, more bearish sentiment. We have a double bottom formation, the exact same setup that we had again back in August. We're seeing almost a mirror image of what happened back in August. We had a top, an attempted rally, failure, and now we're expecting significant downside ahead. We have now had this break to the upside, a retest of this prior support, a prior resistance line in the put to call ratio. So break, retest, and now ready to see some significant downside ahead, somewhat similar to what we had again back in August. So get ready for some pain ahead. Let's take a look at the fear and greed index. We're now hovering above the 125-day moving average with declining momentum, with more and more bearish momentum. We're now seeing stock price strength faltering at the top, breadth collapsing, as well as put to call ratio forming a higher low, ready to move to the upside, push to the upside. Market volatility, again, we'll see market volatility cross above the 50-day moving average as soon as this week, if not then next week. Safe haven demand is growing, bonds are outperforming stocks, and then we have junk bond demand collapsing as bond investors run to safety. So what do we have next? We have the FOMC economic projections coming out at 2 p.m. Eastern time, and then the press conference at 2:30 p.m. Eastern time. I expect some exceptionally violent moves Wednesday. Thursday we'll have retail sales, and Friday we'll have PMI flash. Not really as important as the FOMC meeting. The FOMC meeting is going to establish the next direction, which is likely again going to be to the downside, confirming this double top in the S&P 500. 2,000 likes and open 10 spots in the Living Legend membership, and 50% off for Ghost Legend annual membership. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.